It's a word that I don't like very much called whiplash. Whiplash. And that's what's happening in the market right now. We had an extreme event in December with the massive sell-off. People were just scared to death of the market. And then we've had this rebound because they were scared to death. Any movement at all pushed prices up very rapidly. And we're back up to about where we were on a technical basis back before the decline. So it's vulnerable. The market is vulnerable. And one of the things, and I know this is going to sound funny, but we have an indicator we use, and it's whether Congress is in session or not. And
really?
It's back in session. And that's not good for the market. Doesn't matter parties. It's not good for the market.
Well, they're in session a lot, Barry.
Yeah. Well, they are, but we actually track that on a daily basis, and you find that you make money when they're not in session and you lose money when they are in session.
All right, Ben, let me bring you in here. So we've learned today that President Xi Jinping and our president may not be meeting before March 1. Mm-hmm. That means that for weeks now going into this, we've heard positive commentary from Secretary Mnuchin, from others indicating that there's progress, that Mnuchin is part of the delegation going to China, and that we were basically just going to seal the deal. Mm-hmm. What happens now? Do you think 25% tariffs are really coming?
I mean, more generally, I think it's a reminder that there's a lot of downside risk on the table here, and the nature of that risk has changed somewhat. And so in December and Q4 of last year, it was a story of economic momentum. What happens as the U.S. economy slows? And that story has shifted from the momentum story to event risk coming up in February and March of this year. Event risk around trade, which we're seeing today. Event risk around Brexit as you approach that deadline. I'd say event risk around the March FOMC meeting as well. And a question of what is the Fed's reaction function? Have we got a good handle on that? But insofar as trade in particular, I think, the part of the issue was that all the good news was priced in to some extent. So you had a bit of a negative asymmetry where the contours of the agreement were coming into view, and markets were taking that on board.
I think a lot of it also goes back to when Chair Powell came out and said, he basically flipped from more hawkish rhetoric talking about rate hikes to the opposite. So that set the groundwork for a lot of the rally that we've seen, even with the event risks that you're talking about coming up. So how important does the trade issue offset that, or does it only offset it if those tariffs go in?
So, I mean, just to maybe backtrack to your original question, I'm not convinced those tariffs actually do go into place, even if you approach that deadline in March. I think, there's a lot of constructive conversation that's been had. I think that the agreement itself seems somewhat narrow in nature, and so it's clear that China's going to buy a lot more goods that the U.S. exports. A little bit friendlier treatment for U.S. firms operating in China, but it's not a panacea for all the concerns that started this thing in the first place. So industrial policy in China, intellectual property, those have been kind of silent, which is an indication that it's going to take a long time to get the agreement, an agreement that's comprehensive. It's not surprising they can't do that in a couple of months. And so I think as they approach, if there's still that positive momentum, they're just going to push out the deadline from there. And
so, Barry, can you own Micron? Can you own the market going into all of this, or as we wade through it?
Yes, I think the risks in the short term are fairly balanced. And so when they're balanced, you look at the last direction, and that is an upward direction in the market right now. So we done some buying back in December in our funds, and we're continuing to hold. We haven't sold out of those at this time, but we do expect to see this kind of bump after a really whipsawed back up market. This is not unexpected at all.
Let me ask you about something a little more long term, Barry. There's a proposal by a Hawaii Democrat that would be a financial transaction tax to effectively tax trading. It's already been proposed by Germany and France, so maybe gaining some momentum in Europe. What happens if something like that is imposed in the U.S.?
The thing about money is it's like water. It follows the path of least resistance. So if they do put something like that on there, there's going to be other things that will rise up to kind of absorb that, if you will. It will put a dampening overall on the markets. Whenever you impede, free enterprise, as it were, it makes things less efficient, and it would not be good for the market at all.
And Ben, if the goal is to make less high-frequency trading, this is a way of saying, look, we don't want these quote-unquote bad guys in the market. Is there a way to even suss that out, or is it just going to harm everybody else?
I think introducing a friction is always dangerous insofar as it can have unintended consequences. I think it's an empirical question in this case. I think you've had examples of those types of restrictions that have been relatively benign, others which have been a little bit more difficult to navigate for the investment community. So I wouldn't come out either way strongly on this specific proposal. What I would say is that it's one more reason at this moment to be a little bit cautious. So we were cautious as we navigated the deceleration narrative at the end of last year, which is still ongoing in the rest of the world.